Hi, welcome. In this video, I will explain joint arrangements under IFRS 11 for ACCA SBR in a simple and exam-focused way. A rule of thumb: these percentages are indicators. Do not use them as automatic rules. Please do not rely only on percentages, and always assess control and influence, whether there is significant influence or not, and if it is sole control or joint control, to identify the interest in other entities. What is a joint arrangement? It exists when two or more parties have joint control of an arrangement. Joint control means that decisions about relevant activities require the unanimous consent of the parties sharing control. In simple terms, all parties that share control must agree before any relevant decision is made, and if even one party disagrees, the decision cannot be taken. So that's what unanimous consent means. Relevant activities are activities that significantly affect returns, such as budgets, capital expenditure, and operational policies. Percentage alone does not determine joint control. Even with 50% ownership, joint control exists only if the contractual agreement requires unanimous consent. Assess contractual agreement whether there is unanimous consent to determine if there is joint control or not. A joint venture exists when the parties have rights to the net assets of the arrangement. The joint venture is usually a separate legal entity, and each party accounts for its interest using equity method in consolidated financial statements. A joint operation exists when the parties have rights to the assets and obligations for the liabilities of the arrangement. Joint operations are common in industries like oil, gas, and construction. Each party recognizes its share of assets, its share of liabilities, and its share of income and expense. As for joint venture, in the individual financial statement, it can be recorded at cost or in accordance with IFRS 9 or by using equity method. As for consolidation purposes, it will be recorded under equity method. As for joint operation and consolidation purposes, the individual financial statements will be automatically carried to the consolidated financial statements. Let's recap. Does the investor have sole control of the investee? If yes, it is a subsidiary. Sole control. Consolidate and make disclosures. If there is no sole control, does the investor have joint control of another entity? If yes, if there is joint control, it is a joint arrangement. If there is joint control, then does it compromise an interest in net assets of a separate entity? If yes, it is a joint venture. If It doesn't compromise an interest in net assets of a separate entity. It is a joint operation. If there is no sole control, and if there is no joint control, does the investor exercise significant influence over the investee? If there is significant influence, it is an associate. If not, it is a financial asset if there is no significant influence. These are the standards related. That's all for this video. I hope this explanation was helpful and thank you for watching. There is a disclaimer: this video is for educational purposes only and reflects my personal understanding of the ACCA SBR syllabus. It is not affiliated with or endorsed by ACCA and study texts.